Hello. It's January 20th. Wow, inauguration day, a history making day. So we'll look at this day 20 years from now and see what happens. But we're not going to talk about politics, but I wanted to mention it. It just came to my mind. But we have an exciting program today. There's a lot of confusion about real estate, about the mortgage rate, about the housing prices, not only to the buyers and sellers and investors, but including us, agents, realtors, escrow officers, title officers. Everybody's wondering what the heck's going to go on this year in 2025. So we're going to discuss about a lot of things, different things, home prices, multiple offers, bad markets, good markets, mortgage rates, affordability. We got a whole thing going on today. So it's going to be a great discussion today. But to help me with this discussion, I have my second time guest to help me, Mathew Share. He was on here a couple of months ago. He had a great topic. We had a great discussion. So I'm going to bring Mathew back in. Mathew, welcome again. Mathew Share is from Atlanta.
Yeah.
Introduce yourself and we'll take it from there.
Okay. So I'm Mathew Share. As you said, I'm in the Atlanta market. I am both a real estate agent and also a mortgage loan originator. So I kind of have input from both sides of the fence there as far as what's going on with financing as well as the market.
Right. So. Okay. How long have you been doing the loans and real estate, both together, or are you more loans?
No, so the real estate agent, I've been doing that this is my 21st year as a real estate agent. Lending, I've only been in for about a year and a half. That's a new service expansion for me.
Right. Okay, cool.
More products.
Yeah. And like I said, Matthew's going to help me discuss about what's going on. So to get started, Mathew, what's going on Atlanta and that side? And I'll talk about what's happening on my side. I'm in Anaheim Hills, Orange County, if you don't know us. By the way, we would love to hear from you as we go along in your local markets. Let us know what's going on. Make some comments. If any questions.
By the way, where you are, I wanted to ask you, are you directly impacted by the fires? Or
no, thanks for asking. I'm about an hour away from the fires. So everything's happening west of downtown. I'm east of downtown. So we're in Orange County. It's in LA, and it's really tragic. I have some friends who are evacuated. It's mind-blowing what's happening. It's a natural disaster. We can't blame anybody, but it is happening. It's still happening. There's more fires today.
Yeah, it's horrible.
And there's more wind coming today. So we're praying that nothing gets worse, but we'll see what happens. I mean, it's a sad thing to,
But as far as, as far as what's going on in Atlanta, no fires here.
Okay.
Thankfully, we're very cold tonight, but that's about it. And we may have some more snow coming tomorrow, so which is rare here.
Okay.
But as far as the market, trying to say what's going on even within the Atlanta metro, I think there are very different markets in different parts of the city. You go, different directions, even places that are 20, 30 miles apart could have totally different market conditions right now.
Right. Okay.
And I think a lot of that has to do with the kind of the average income of particular areas. I think the areas with the higher income people are generally doing better right now because the people that are buying they just have the ability to navigate through the we have affordability issues going on.
Right.
The affordability issues are affecting the lower income folks more. So it's kind of making two markets at the same time.
Right. Yeah. What I want to do is start off I came up with an article and I want to kind of read that to start off this process. And this article is from Fanny May. So I just want to share with you. Are you seeing it? The housing market unlikely to thaw. Yeah. Okay. So this is from Fanny May. Housing market unlikely to thaw in 2025 due to affordability challenges and lock-in effect. And here's where the confusion is. On one way, people are saying that the market is going to be tough. There's no affordability. But I'll talk about Southern California. The things are popping over here. So it's like a confusion, So Fannie Mae economists share 5 housing market predictions for the new year. Let me read the first paragraphs and then I'll read the 5 predictions So Affordability and the so-called lock-in effect are expected to keep housing activity subdued in 2025, with existing home sales forecast to move only slightly upward from recent multi-decade lows, according to the December 2024 commentary from Fanny May. The broader economy is expected to remain on solid footing and expect at an above trend pace through 2026, and it as it navigates elevated core inflationary pressures and heightened policy uncertainty. As part of its latest outlook, Fannie Mae's economists shared 5 predictions for the housing market in 2025. So let me read that, Matthew, and we'll kind of discuss it a little bit and then move
Sure.
on with what we have in mind today. So the prediction is the average mortgage rates will decline modestly but remain above 6% with likely bouts of volatility. Let's see what happens. That's what they said last year,
Mhm.
but the darn mortgages went up. Existing home sales will remain near 30-year lows, but location matters. Very true. New home sales will remain a bright spot in the housing market where they can be built. As you know, there's a shortage of homes being built.
Yep.
4, national home prices growth will decelerate. Okay. And then the last one, multifamily housing will remain in a holding pattern. We won't talk much about the multi-housing family. We want to talk about our bread and butter homes. So let's start with the first one, Matthew, and you're a lender as well as a realtor. Let's talk
Sure.
about the rates. What happened last year? First of all, they said, oh yeah, they're gonna drop. And then it went up to 7%. Now they're saying it's gonna drop. I mean, are they pulling our teeth or legs or what the heck's going on?
Well, well, so the thing is, the Federal Reserve controls short-term interest rates. So they might, and those did drop. They
Mhm.
came down a full percentage point, I think, in the last quarter of the year, really.
Right.
So they did several drops, but the mortgage rates did not follow suit. Federal Reserve doesn't control mortgage rates. Mortgage rates are kind of just like the stock market. They're based on what people think the future cost of borrowing money will be in the long term.
Mm-hmm.
And so since it's market driven and there's a lot of uncertainty and a lot of things potentially coming down the pike that could influence things,
Mm-hmm.
they're looking at, what is the likelihood. Basically, what it comes down to is the likelihood that the Fed will continue to lower the short-term rates is what drives the mortgage rates.
Okay.
So the fact that mortgage rates have not come down and actually went up towards the end of the year is indicative to me that the market thinks that the Fed is not going to continue lowering rates anymore, and in fact might even have to do rate increases. And it means that they're basically expecting inflation to rear its ugly head again. And if
Okay.
inflation rears its ugly head, the
Right.
Federal Reserve will have to, at a minimum, stop reducing rates and possibly
Right.
increase.
Okay.
And so the market's pricing that in. They're pricing in the
Right.
uncertainty and the possibility of that.
So I did a little very short video today on TikTok. TikTok came back, people were scared and it came. So I did a video today, and the video was about, should I wait or should I buy? What's the right time? What's a bad time? What's the right time? And most people decide obviously on home prices, but I think the number one factor they decide on is, will buy when the rates come down so my payment drops. What's the good and bad about waiting for the interest rate to go up or down? Because you don't know what's going to happen.
Well, what's bad is, first of all, there's a ton of, which I think you had mentioned before, there's a lot of pent up demand. There are a lot of people that are waiting for, I can't tell you how many people I talk to every day that are like, well, I'm not buying till interest rates drop. And they're all sitting on the sidelines. So if the rates actually do drop, they're all going to enter the market at the same time. And that will definitely drive prices up
Absolutely.
much faster than the
Yes,
the
it's a
prediction.
catch-22. Yeah.
Yeah, it'll put people back in bidding wars and everything. Right now, in my market, it's actually a great time because for the first time in years, you can actually negotiate a little bit on a house. Maybe you don't have to pay list price. Maybe
Right.
you can get the seller to pay your closing costs for you.
Okay.
There's stuff that we haven't had the luxury of having that in years.
Wow. Okay. So
Um,
which tells me that if that's the case, you have higher inventory and the prices are slightly dropping and not increasing. Is that true? Or?
well, I wouldn't say dropping necessarily. There are a lot of, and that depends on which media outlet you're looking at and what kind of spin they're trying to put on it. So prices overall are still rising. They are rising at a much slower rate than they were before.
Mm-hmm.
And there are a lot of price reductions, but the price reductions are because some people that are listing their homes are still thinking that it's a frenzied 20% in 1 year increase kind of market, and they're overpricing their home, at prices that probably wouldn't have worked even a couple of years ago when things were moving that quickly.
Yeah.
But now certainly, they're getting greedy. I think a lot of sellers are like putting their home up for ridiculously high prices and then subsequently having to reduce them.
Right.
But as far as what they're actually selling for on an aggregate basis, you can't look at one example of like one house that reduced its price. You look at the data across the board.
Exactly. That's the issue we're having. The issue that I'm having is they look at Zillow. Like, I'll give you an example. There's a friend of mine who listed his house, and he listed it for what Redfin said, right? It was 1.1. Then he sent me a text and says, oh, wait a minute. Zillow is showing 1.2. So can we change the price? So I sent them a Realtor.com value, which was under both of them. So I said, well, how about the buyer pays you $900, $950? Because that's what Realtor is showing, Realtor.com.
Yeah.
So you can't rely on this data and what this data is doing. And I truly believe this is all these media companies, Zillow, Realtor.com, Opendoor, Redfin, all those are making these buyers and sellers confused. And I can totally tell you a lot of them are confused or don't know how to make a decision. On top of that, I tell the buyers and sellers, I'm going through one negotiating right now, saying, look, Zillow is saying 1.2. Why are they asking for 1.25? And there's a lot of emotional stuff going on. When there's 10 offers, of course the seller is going to ask for more. And then when I call the agent goes, hey, if you don't have an all cash offer, don't even bother bringing it. That's what he said. So when I call my buyer, say they're only taking cash offers, he goes, what if I offer $25,000 more? And the agent told me, number one, they want all cash, no contingency, closing 10 days, no inspection or nothing. You can do it, but they're not going to do anything. So the seller's thinking, oh my God, my house is hot. I got 10 offers in the first 2 days. I had 80 people in the open house. Seller's thinking, I'm the king. Hey, don't mess with me. And the buyer's saying, hey, what I'm going to do? So it's hard for us to understand. And that's what I'm talking about, that sellers and buyers have to understand what's going on that particular house. Forget the market, national market, forget the city market. What's happening in that track? One track may be very hot compared to the other track. So it's very hyper local, and that's hard to decide. But let's carry on, and let's go to point number 2 on this prediction is existing home sales will remain near 30-year lows, but location matters. So what does that tell you? If you're a buyer or seller, what does that mean to you?
Well, I mean, like we talked about, it can be very different market conditions from one area to another. Home sales remaining near 30-year lows does not mean homes are not the homes that are. See, some people read that and they think it sounds like the homes that are on the market are not selling.
Yeah,
but it does not mean that. It means there are fewer transactions because there's just not a ton of inventory. And we have a situation where in my market, buyer demand is down. The higher interest rates are keeping the buyer on the fence, but the supply is also very limited and down.
Right.
So the balance of supply and demand is still such that the homes are selling fairly quickly and very close to their. And
the sales are low because the inventory is low, and the inventory is low because there's just not, the new builders could not keep up with it. A lot of the sellers who refinance at 3%, 4%, 5% are not moving anymore. During the COVID times, a lot of these sellers remodel, including myself, spend $100,000 or more in the house, and I'm not going to go anywhere because my money is in the house and I'm going to stay here. So a lot of factors. There's also remote working. A lot of people work remotely, which is kind of going away, but that's one of the reasons they were not moving, so there's a lot of factors. Just because home sales are staying low doesn't mean the market is bad. It's just there's low inventory, but the demand is very high, so.
Exactly.
Yeah. So number 3, it says new home sales will remain a bright spot in the housing market where they can be built.
Right. So in my market, new homes are moving pretty well. Part of the reason is the builders have started subsidizing the financing. So people that are buying new construction, I do loans also, but I usually can't compete with the builder's lender.
Oh yeah,
the builder's lender is getting subsidized by the builder, and they're offering 4.9%.
Yep.
So it's subsidized financing, and that's driving more people to buy because you can buy a new construction, get a much lower interest rate than a resale can give you.
Mm-hmm.
But the thing is, in my market, well, I'm in an area called Cobb County, in Georgia, and the part of Marietta area where I live, there's not really any significant land available to build on. So it's all built up already. There's a few tear down houses, or they squeeze an extra 2 houses over here, 3 over there, but there's no like big tract building going on because they just don't have the land.
Right.
And so we're not as impacted, but you go further out into more rural areas, and I think there is a bright spot there. But the builders are very jittery because of their experience in 2008, 2009. They don't want to build spec homes. They're keeping very low inventory, and they're only starting to pour a foundation when they have a contract and a deposit.
Right.
So that's going to keep them from overbuilding.
Right. Okay. Yeah, and same thing here, Orange County, Southern California. There's not much land there, so there's not much construction. But the new homes are selling with incentives, and they throw in the new upgraded carpet or flooring. They throw in stainless steel appliances, so they sell them. The fourth thing they're predicting, Fannie Mae, is that the national home price growth will decelerate. I'm not sure if they say that the home price growth, are they talking about the sales price, or what are they talking about?
Well, I think they're talking about the home price growth. In other words, the value of homes is not going to go down, but the rate of increase is going to go down. And that's all they're saying.
That's all they're saying. Yeah. Okay.
They'll still go up, but they're going to go up less than they went up.
Exactly. Right. Yeah. Okay. Yeah. So I'm going to bring out another screen here, and we're going to talk about, if you can see, let me share it. Let's see, where is it? Present, share screen, best states. Okay, share. So this one, let's talk about the 10 best states where the prices went up. What are the hottest real estate markets for 2024? Of course,
Thomaston, Georgia.
Yeah, can you believe that? So I just want to talk about what people think is very hot versus what is actually hot. So I just want to mention this. This is from the website District Lending. Here's a list of 21 states and 60 cities with the hottest real estate markets in 2024. It's past tense, but let's talk about it. This list contains real estate market estimated to increase in value by 7% or more by February 2025. So let's look at the growth. Let's look at the first 10. We're not going to go through all 60 of them, but just to give a perspective. First of all, it's your state, Thomaston. I don't even know where that is. 10% increase.
I don't either.
Okay,
it's far enough away that I don't even know.
Exactly, but 10% growth, and this is 1 year growth increase estimated in percentage. Okay,
I'm gonna learn where that is now, though.
Yeah, Clewiston, Florida. I know where Florida is. I know by map where it is. 9%, and I'm surprised we are seeing Florida here because Florida is taking a big hit. But this must be a way away from these storm areas. Jackson, Wyoming, 9.3%. Wauchula, Florida, 8.9%. Steamboat Springs, Colorado, 8.7% increase. Mountain Home, Idaho, 8.7%. Butte, Montana, 8.7%. Cedartown, here's another Georgia one, 8.6%. So we've never heard of these things, um, this is a
So
prediction, but let's look at another slide here, and then we'll talk about both together. Let me go back here.
and I do want to just say on these, a lot of these,
Sure.
maybe not Steamboat Springs and stuff, but a lot of these are more kind of rural areas where
Exactly.
And the reason they're having such growth is the first time buyers and lower income people that don't have a lot of cash and a lot of it's more affordable. Like the affordability is better in those places. So that's kind of the market of the day is the places that are more affordable. People are flocking there. So.
Yeah, or somebody who retires. Let's say I retire. I'm retiring. I sell my house in California. Orange County average home is $1 million. Let's say I sell it, pay off a loan that I have. Then I move to Thomaston, Georgia. I pay something for what? 150, 200, 300,000, whatever the price is. Pay cash. I have my living and I have a good savings account. I can have a life of a lifetime. But then I have to adjust to the rural area, and assuming it is rural or suburban, we have to adjust for it. Clewiston, Florida. I know by map, but it's not a smaller town. It's pretty close to some other towns. But
I'll tell you, there's some of these places because of this trend, and I think it's going to continue. Probably excellent places to invest in right now.
Yeah.
I'm as soon as we get off this call, I'm going to look up Thomaston and Cedartown and see about
let me know.
Some land or something.
Right. Yeah, check it out. Let me know. Send me some. Maybe I have some investors who may buy. So let me know. You may have a sale. So, let's go to another screen and share another one that shows you the opposite of what's going on. So let me go to stop this screen and go to share screen on my third one, which is home prices. Okay, realtor.com. There it is. Okay, what realtor.com is talking about, if you can see it, home prices are plummeting in some of the nation's most desirable places to live, especially in these 10 cities. I have no idea what it is. I haven't read this article, but I'm curious to find out. This is from realtor.com. This article is as of October 2024. So let's look at these thing. Let's look at the first, why the prices are decreasing. I'll read the first paragraph. Remote work trend certainly played a role, but I think many of the people that have come to Florida were more focused on the benefits of no state income tax as well as political ideologies. Owner of Savvy Buyers Realty, blah, blah, blah. Okay. So now let's look at the metros where home prices have decreased the most. This is like saying that the lowest top 10 where they have decreased, right? We looked at the other one where there's going to be most decreases. So this is the reverse.
And I would like to point something very important out.
Sure.
People need to be very careful with this. Anytime you see reports that are referring to median list price, median price just means the middle price. Okay.
Right.
So if more starter homes are selling and less luxury homes, then the median price is down, but that doesn't mean that the price of each house went down by 12.4%. It just means the market is more skewed towards lower cost housing.
Exactly. And if I were to do this myself on these, and if I used average prices instead of median prices, this will be I bet you all these 10 wouldn't even be here.
Totally different numbers.
Yeah.
Right. And the average price would have more meaning to me. I always hate when they use median and people misunderstand it.
Yeah, it's very misleading. We won't get into the math on this, but median sales price and the average are two different things. And if this research was done on average prices, maybe we'll have 10 different cities. But let's go with, this is realtor.com thing. So let's look at the prices. The number one with the metros where home prices have decreased the most. And this, I'm assuming it's year over year. Medium list price of 525. Yes, it is year over year change. That means, let's say it's 2024. It's decreased by 12.4%. And I'm pretty sure a big reason for this is the disasters. the collapse of the building, which
Absolutely.
insinuated, ignited the HOA wars, the HOA reassessments, and the insurance, which
The
demanded
insurance is out of control.
out of control.
And
Yeah.
California is going to have the same problem.
Yeah, I just did a video that's coming out this Sunday, talks about the impact of insurance is having on the housing market, and it could be property taxes and insurance could be one of the reasons there could be foreclosures as we move along. Nobody thought it would be, but if something that can bring down the housing, it'll be insurance and property taxes, the way it's going. So it's something to think about. Let's talk about Cincinnati, Ohio. Median list price of $337. There's a drop of 10%. Are you close to Cincinnati? What do you know about, or what's the cause over there?
I don't really know anything about Cincinnati, but I would just say all these cities, of course, with affordability being down, I guess people are having to go to the outskirts of Cincinnati. I don't know if they're considering it only within the city limits, or
I'm assuming it's a city of, we're going to assume it's just Cincinnati, so these are
by I'm not going to sit here and claim that I know the Cincinnati market.
Okay.
I've never been there.
Right. Okay. Let's talk about San Francisco. Obviously, San Francisco is 9%. I know that who would have thought this would be a factor, but here's one of the factors causing home price drop. Indirectly, homelessness, right? Am I saying that right? Homelessness. Because of this, a lot of homeless people there, and you cannot park or go in the shopping centers or the hotels. A lot of these are closing. A lot of the companies are moving out. On top of the homelessness, we have a lot of companies, Google, Meta, Elon Musk company, Tesla. They've moved a lot of people out. They've moved out of the area. There's been a lot of layoffs. The prices have gone up so much in the San Francisco area, so ridiculously high. I think the average or the median home price in San Francisco is 1.8 million, and it's out of reach. Nobody can buy homes. So all the workers, the labor force, the blue collar workers, they have to drive from an hour away. And that's causing this impact. I mean, I'm sure there's other reasons, but that's a big drop. You take a $2 million home and drop it by 9%. That's almost $200,000, $180,000 drop. That's a big chunk. If you have a $4 million house, which is pretty normal over there, $3 or $4 million homes, at 9%, that's $360,000 off your price.
Sure.
That's a big chunk. That's a big equity gone, So Austin, oh my gosh. Austin. I've been hearing a lot. Austin is taking a big loss since last year. 2023 took a beating. It took a beating in 2024. Is it overbuilt or what's going on there?
I don't know. I did go to Austin on a trip, on a vacation.
Okay.
So I've been there. I was in the urban city area.
Okay.
Looked like it was jumping to me. I mean, it looked like there was a lot of commercial development in the and redevelopment. Did not look like a depressed market to me at all.
No, yeah, I've seen some videos last year because I do a lot of YouTube, and I know there's at least 3 videos I've seen. It says "Get Out of Austin." They all have over 1 million views. Yeah. And one of the things, the common things they say about Austin, there's other factors, but one of the biggest thing is there's overbuilt of homes. There's so many homes, and again, there's layoffs, so people are moving back. There was another report that a lot of the Californians who came to Austin and San Antonio and other states, other cities of Texas and Idaho, they're moving back. They could not adjust to the weather or the culture or the lifestyle.
It's also, it seemed like a very young city. A lot of young people.
Millennials,
yeah, a lot of millennials, young people. So that might have something to do with it.
So let's move on. We won't talk about all the cities, but another one is Orlando, Florida. See the commonality? Orlando, Tampa, Miami. It's coming back. Jacksonville. So in this list, 4 of the cities, Miami, Jacksonville, Orlando, Tampa. Big chunks, 5-6%. And let's talk about Florida in general. I want to compare, just for the comparison, what's happening right now in Southern California. And this is first-hand knowledge because I showed homes over the weekend. Last 2 weekends, I've been showing homes. And there's open houses. There's 40 people per day, Saturday, Sunday. We wrote 2 offers, and on both the homes, there were 10 offers each. One was listed at $910. It's selling at $1,050,000. We lost that one. One is listed for $890,000, which I showed yesterday. And the agent told me that if you don't have an offer at $950,000, don't bother. He's going to sell over $950,000. This is with 7% interest rates. This is after the home prices are high. That's what's happening in Southern California, at least in Orange County. And I know that LA, I don't know what's going to happen in LA because of the fire. So I'm not going to talk about what's going to happen, but this is happening a lot of areas in Orange County. What's happening in Florida, we just seen what's happening. Jacksonville, Orlando, Miami, Tampa, there's drops. And I think the major factor, number one, is there's a lot of vacant homes because of the disaster. A lot of people are leaving the homes because when the insurance skyrocketed, you're talking 2 or 3 times the premium or 5 times the premium. Not only did the insurance skyrocket, 2 things happen on HOA because of the new regulations, because of the collapse of the building. Insurance went up. And then all these with the new regulation in Florida, where any condo story building over 3 stories has to be reassessed and inspected. Some of these condo owners are having an assessment of $20,000 per unit, $50,000 per unit, $60,000. I've heard of $100,000 per unit that they have to come up. Then the HOA went from $200 to $800. So here you have a property tax going up in Florida. You have insurance skyrocketing. Your HOA is skyrocketing, and then you have these assessment fees. Who's going to buy those? That's what's happening in Florida. There's over 50,000 vacant homes that are for sale that are vacant, or they used to be about 5 months ago. I don't know what happened right now, but that's what's happening in Florida. It's totally opposite. So next year we may see a big drop. I saw another post on YouTube today. This guy was talking about a house that was listed for $500,000. Has been sitting on the market for 8 months, sold for $295,000. This is one house, and I'm not saying all of it like this, but this one house will have an impact on that neighborhood. That neighborhood will have an impact on other neighborhoods, and it's a domino effect. But Florida is what I call in trouble, and I mean it in a nice way. Not, I feel sorry for what's happening with the disaster relief. Disasters happening, people still have to fix homes. So I mean it in a way that, home prices are being affected drastically. The net migration, the more less and less people are coming into Florida like they used to compared to 2 years ago, and more people are going out of Florida compared to 2 years ago, including Californians are coming back, and all the people who moved from New York or whatever are moving out. So we are seeing, and that's why the topic, it says, something very weird is happening in the housing market. One thing we can tell is the housing market is local, hyper local. So what's happening in Atlanta may not be happening in Southern California, and what's happening in Florida. Yeah. So keep that in mind when you see this report from Realtor.com and, hey, prices are up 10% or prices are down 10%. Talk to your local realtor. Right. Get your own, because what's happening.
The analogy I use is you can't make a housing report that's nationwide. That is like trying to have a nationwide weather report. So
can't have it. Yeah.
It's going to be different.
Yeah. Let's look at a couple of other cities. Well, Nashville. I know Nashville. I don't know. I have no idea about Nashville. In fact, I'm going there in May for a golf tournament. And I know that I did a video on Airbnb 4 months ago, and there's a town near Nashville, I think it's called Page or something, has a big drop in Airbnb business, and that's affecting the housing, and there's over construction in the Nashville area also. The medium list price is $547, and that's Nashville. But if you look at the suburbs of Nashville, there's so many suburbs where homes are 200, 300, 400,000, a lot lower. So that may be affecting where people are moving out of the metro areas, going into suburban areas, going an hour away out of Nashville or something. But that could be a factor. I mean, I'm just throwing that out there, so So, that's one of the things I was going to decide and talk about. But what other change are you seeing on your perspective, being a lender and a realtor?
Well, first of all, in my market, there's a lot of the investor groups, the Black Rocks and big groups like that. They are still out there trying to acquire homes and turning them into rentals. Okay. So So the buyers, especially the lower end of the market, again, those first-time buyer type houses,
Mm-hmm.
buyers are competing with those cash investors.
Right.
And that's still going on. They
Right.
are still going strong. My phone rings 10 times a day with people asking me if I want to sell or whatever, investors looking to buy my house. So there's a
Right.
lot of that going on.
Right.
Trying to think what else. And as far as mortgages, um, I think what I am noticing a lot is a lot of people that are getting a lot of other debt, credit card debt and stuff.
Ooh, yeah,
So
big one. Yeah.
and sometimes I'm able to help those people because people are so fixated on, oh, I have this great interest rate on my mortgage, so I don't want to refinance. But sometimes it actually makes sense to refinance at a higher rate
Mm-hmm.
if you're if you're doing a cash out refinance and you're getting rid of a bunch of 25%,
Yep.
credit card,
Correct.
interest
That's a
you're
very
paying.
big point. Yeah. And then refinance again when it drops again, so yeah.
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 So we're having that. And a lot of my buyers that are buying homes are kind of banking on being able to refinance in the
Mm-hmm.
future. And I hope they will. I wish we were already there.
Right.
I think they will eventually. I
Right.
hope they do, because if they don't, I'm gonna have a lot of buyers coming back to me saying, "You told me I could refinance."
Yeah. Yeah. Yeah.
But I
Yeah.
mean, I don't control the rates, but
Right. Right.
I do think we're gonna get there. It's just
Yeah.
taking a
Yeah.
little longer than
Yeah.
we thought.
Okay. So I'm going to turn the table a little bit and talk about something that, the topic says something very weird is happening in the housing market, and we don't know what's happening. But today's inauguration day, and there's a reason I mentioned that. So what's going to happen is Trump administration has said several things that may affect the housing market,
Mhm.
maybe after a year, 2 years. So let's chat briefly about that as a combination. Number one is, if there's a mass deportation of 10, 15, 20 million dollars, not dollars, 20 million people, there's going to be a labor shortage or housing shortage in construction because there's a lot of legal and illegal immigrants working in that industry. So let's, number one. Number two, how is the tariff going to impact? If he signs an executive order today, I heard that he's going to sign 20, 30 executive orders. One of the big things was tariffs. Hey, charge 20% Mexico, Canada, China.
Mhm.
How will that affect lumber prices, other prices, and affect construction? Then he's
Most
talking
of our,
about the taxes and the deregulation. So what impact can it have if something like that happens? So, that's a monkey in
well,
the wrench,
the majority of our lumber that is used to build houses here comes from Canada.
Okay.
That is the biggest supplier of lumber by
Right.
far. So 25% tariff on all Canadian goods is going to raise the cost of lumber by 25% overnight, which means the builders it's going to cost them, a lot more to build the houses, and they're not going to sell them at a loss. I promise you that.
Right.
And they don't have a lot of inventory, so it's not like they're going to get stuck having a fire sale them.
Right.
They just won't build.
Mm-hmm. Yep.
So now I have heard some thoughts, which is very interesting and unprecedented. If tariffs are implemented and everything else is kept as it is,
Mm-hmm.
it's going to be a disaster. That is just not, I don't agree, and I'm trying not to get into politics here, but I just don't
Right.
think that's a good plan. However,
Right.
I have heard that Trump's kind of master plan, which is very intriguing actually,
Mm-hmm.
is to have the tariffs, but essentially the tariffs will generate a lot of revenue, and that revenue could reduce our income taxes. Now, if you have, high tariffs, but lower income taxes, or eliminate income tax even eventually, that they could cancel each other out. Exactly how that will work, it's going to be very interesting because it's unprecedented.
Right.
Essentially, I view that as a way of forcing upon us something that I've always thought was a good idea, which is a consumption tax
Mm-hmm.
instead of income tax.
Okay.
Um,
Yeah.
so if if it goes that way, I think there's a possibility that the extra money in people's pockets from not having to pay as much income tax will offset they'll be willing to pay the extra 25%
Right.
for the imported goods.
Yeah.
So, but it really depends on what else is done in conjunction with the tariff.
Right.
But
Okay.
if you keep everything the same and you just add tariffs, it's going to cause inflation, which is going to cause interest rates to rise even further.
Right.
Which is going to cause more layoffs, higher unemployment. It's going to put the economy in a very bad state.
Right. Right. Yeah. That's why we don't know what's going to happen.
I think Trump knows that, though.
Yeah. Yeah. Okay.
I'm hoping that he's smart enough to realize that and have a bigger plan in mind. I hope.
Right. Well, one thing we know, he's going to do what he's going to do, regardless.
Yeah.
Right. So, but we'll leave it at that. We don't want to get into politics, So,
right.
One of the things I want to bring out that'll affect, and it has happened because the mortgage rates went up. And if you go back to 2005, 2006, 2007, I'm sure you were around then. There were a lot of different kind of mortgages. And I'm hearing that some of those mortgages are coming back. When the rates go up, I'm talking about the variable mortgages, 7-year or 10-year or 20-year, because the rates are lower. The adjustable rate mortgages. I'm hearing about the buy downs, the 2-to-1 buy downs are coming back. And then we have the assumable financing. So how much of those loans, we don't have to get into these loans. We won't talk about the specifics about the loans, but how much impact will this help buyers, or would you recommend buyers to get these kind of loans? There's also mortgage loans, which I personally don't like, but.
Right. Well, okay. The assumable aspect is just FHA and possibly VA.
Right.
And those are hard to assume now. There are companies out there that trying to get people homes with lower end, but you can only assume the amount that the person has borrowed, which usually requires you to have a whole bunch of cash that most FHA buyers aren't going to have. So
exactly. So that's
so that's kind of that. Now, as far as the other kinds of loans, the ARMs are coming. They are, a lot of people do them. I do not recommend them for most people because we don't know what interest rates are going to do.
Yeah.
The rate buy downs are a very good, the temporary rate buy downs, like the 2-1 and those kind.
Right.
Very good marketing ploy for a listing agent to use because people do tend to be short-sighted and they think, oh, okay, well, the payment's going to be lower the first couple of years, whatever. Not the smartest thing to do, because if you sell or refinance, which I think most people who are buying a home now are probably going to refinance in the next few years. And all the money that's paid to get that rate bought down with the temporary buy down is sunk costs that you're never going to get back. I would personally rather pay $100 a month more on my mortgage for a year and a half than to pay, $8,000 to buy the rate down for 2 years.
That affects your down payment. I'd rather put that in the down payment, or something.
Yeah, and people look at, but what happens is sometimes the seller of the house is willing to contribute the money to buy the rate down for them. Right. But don't be fooled. It's not free money. If a seller's willing to sell you a home for $800,000 and pay $10,000 to buy your rate down, they'll sell you the same house for $790.
Right.
If you don't take the rate
exactly.
buy down.
And you drop your property tax, everything, right? Is the percentage.
So it's the same as you paying the $10,000 to buy your rate down. And
exactly.
You're better off just paying the higher rate for the short term than refinancing.
Right. The other thing I want to talk about is the trends. I know that there's a talk out there that Gen Zs are not buying anything at all. They're younger, they don't have money, and they don't care. They don't own homes. They're like a lost generation, whatever. I don't want to go there. I don't know much about it, but I know a little bit more about millennials. I have kids who are millennials, right? They're buying. They're a big chunk, a big percentage. I don't know, maybe 30%, 35% of millennials. So what's the impact of the Gen Z and millennials buying or not buying? And what's the impact of baby boomers? I'm also hearing a report that baby boomers, I'm a baby boomer, and they say they have a lot of equity. They have a lot of assets. There's a lot of money sitting that's going to go to their kids. But now I'm hearing that these baby boomers are now not moving. They're deciding to stay. They're supposed to move out from the big house to a
Right.
smaller house. But because of climate changes, Florida is a good place to go. Hawaii is a good place to go, but it's too expensive. So now I'm hearing a report that a lot of the baby boomers that are supposed to move may not move. They're staying put, like me. I remodeled my house 5 years ago during COVID or just before COVID. I'm not going anywhere.
Mm-hmm.
So what's the impact or what's going on with those two categories, millennials, Gen Zs, and the boomers?
Right.
What have you heard?
So I'm a Gen Xer.
Yeah.
But no, I think first of all, millennials are coming around. They are they relate to the game. 10 years ago, people were saying, "Oh, millennials are not buying houses," blah blah blah. But as they didn't buy houses as early as Gen Xers did, but they did enter the market and get in the game. And I think that the Gen Zers will as well. They're just maybe a little later to the table,
Right.
And I think this affordability issue is keeping them waiting, and understandably for many of them.
It's a big factor because that I think it's like 35% of the home buyers are millennials, especially the first time.
And the other thing that's important is there are a lot of millennials. Like I once read something that it's almost like another baby boom. Like there's, in terms of volume of people of that age group, it was a big boom of more population. And so that creates overall more demand for housing.
Okay. Well, the next topic is very important on what's going to happen. So I did a video today. I mentioned earlier, I did a TikTok video, not today, but a couple of days ago, I did a TikTok video based on a report I read. And what the report said is a lot of the states have not fixed property taxes. Like California, we have a fixed, Orange County, we have a fixed property rate of 1.1% fixed, but it goes up by a CPI increase of 2%, 3% or whatever. So it's pretty much fixed. Some other states like Nebraska or New Jersey or Texas, even Florida, they can jump. And in some states, Texas, they've jumped 20, 30, 40, 100%, 300% on property taxes. Combine that with insurance. California, our insurance are jumping. And now with this fire, it's going to go higher because I'm close. So they've doubled, tripled, quadrupled. So what the report said is, you guys, they're saying to the buyers, don't worry about the interest rate and the prices right now. They are what they are, right? They were in 2021, the prices were lower, interest were lower. Home prices are what they are right now. You're going to have to buy it. What you really have to worry about is where you buy, because depending on the state, you have to worry about, are the taxes going to go skyrocket or is the insurance going to skyrocket? And those are variable. Your PI, principal interest, is fixed for 30 years, but your principal and your insurance and taxes are not. And that's going to be a big factor moving on. So the thing I want to talk about, based on that, your property taxes going up, your insurance going sky high, like in Florida, one has to think about moving based on climate change and the climate factor in that state or area, because that'll affect your property taxes a little bit, but more insurance and your HOAs. So that's a big factor going on right now. If I have some people want to move to other states, I say, you know what? I don't know about Texas, Idaho, Montana, whatever. I'll hook you up with an agent and ask them what's happening with insurance.
Send them my way.
Send them your way. Absolutely.
I think I've chosen the right state to live in from that regard. Georgia is not generally. We don't have hurricanes. That we're too far inland. Occasionally we get a little damage, but nothing widespread. Although North Carolina did just get hit, and that could have been us, but that's very rare, extremely rare. So it doesn't affect the rates when it's a once every 500 year kind of thing. It doesn't have the same impact on rates, on insurance rates. And we don't have the wildfires, we don't have earthquakes, we don't have, so there's insurance wise. I mean, our rates have gone up a lot, but like for example, on my home, I think I was paying $1,000 a year for homeowner insurance on a, almost 4,000 square foot home.
Mm-hmm. Yeah.
Now, okay, it's gone up by 50%, 60. Maybe I'm
Mm-hmm.
paying 1,700 instead of 1,000.
Right. So it's not that bad.
It's a substantial increase, but it's still, 125, $150 a month.
Right.
Property taxes here are, we have a millage rate, so they do they assess your property value. They actually have like an appraiser that says what it's worth, and they kind of multiply that by the millage rate. The millage rate, while it can change, it has not changed in decades or maybe even centuries, because no politician wants to change that. It's be very bad for their career.
Right.
So, and they're actually swimming in money right now because the home values went up a lot. They keep the millage rate the same, and they just keep, if a house was doubled in value, they got twice the tax revenue with the same millage rate. But even there, our taxes are pretty low here. Right. Typically, about 1% of the house. Right. You get $800,000 house, $8,000 a year.
$8,000 a year, right? Which
now,
is
and the best part is, if you're a senior, 62 and over, we have tremendous senior tax exemptions here.
Okay.
Many of the counties, you don't even have to pay the school tax portion, which is
okay.
Like my parents live in, well, my mom, my dad has passed away, but my mom lives nearby, and she has a house that's probably about $500,000-$600,000. She pays like maybe $500 a year in property taxes.
Okay, because she's retired.
Anybody over 62. So there's big breaks for seniors.
Right.
So
okay, cool. Yeah, that's some of the trends that's going on. The other thing I want to talk about, and we've talked a little bit about it when we talked about Zillow and Realtor.com and all that, because a lot of the buyers sellers go there and they think that's the price. That's not the price. It's a estimate, which is way off, Right. But now we have AI, and there's a lot of, they can go to ChatGPT, or there's so many other, so they talk to them, especially the millennials, the techie people. The youngsters are more tech savvy than we are. So not only do they go to Zillow and Realtor.com and Opendoor and Redfin, they also go to ChatGPT and ask them questions and things in the market and do some analysis and all that. That's going to affect. We haven't seen it yet, but I see that impact, which may not be accurate.
Yeah. No, it's
because
not.
It depends on what kind of AI you're using. Because if you're using like a cheap AI, because there's so many AI bots out there,
it doesn't matter how good the AI is.
Right.
Like, as far as appraisals, it will never. I mean, until we get to the point where AI can be a robotic, entity that can physically go to a house, walk the lot,
right?
Then maybe, but. No computer algorithm can accurately assess, because there's so many factors. And where I see things like this estimate be off the most is neighborhoods where there's big discrepancies. If they're older homes and maybe some have been renovated and others are all original stuff, they're almost just calculating a price per square foot for the neighborhood.
Right.
And there are a lot of other factors in my area. The lot location can make or break a house and really change the value. We have a pretty hilly terrain here. And you get a house with a nice level backyard that you can fence in, the kids can play back there. It's going to sell for a lot more than one with, some steep driveway, or sometimes you see houses that are in a ditch where the driveway is like a steep drive down or whatever.
Right.
Though, and I think those automated estimates just kind of ignore all that stuff.
Yeah.
They don't.
Like I said, I've been showing homes over the weekend, and there's a town, I won't mention the town, but there's this city has so many offers on most of the homes. There's one house. In fact, the buyer just called me before we went online. He said, let's ask him what they will drop. So we showed $1 million home, $2 or $3 million homes, And this home in particular was 1.18, same square footage. It had a little more upgrade than the other ones, and that's not selling. The other two homes have multiple offers on it.
Right.
The house, which has they spent over $100,000 in updates, has zero offers on it. And you know why? One of the big factors is, one, it's overpriced. But if you go behind the house, right, there's a big electrical pole, the telephone electric pole.
Yeah, that's another
Huge one. And when you go out, and when I was at the open house with my clients, another couple walked in. They came in the backyard and said, "Oh, look at that pole." They walked out.
Yeah.
AI doesn't know that. Zillow doesn't know there's a freaking pole
No.
out there, or there's a creek behind there, or there's a shopping center which makes a lot of noise at night. There's parking.
Exactly.
They jump over the fence. They don't know all that. They don't take those into factors.
Right.
You know.
Yeah, that's exactly it. So they're good for, it's a ballpark estimate, plus or minus literally about 20% is about how accurate it will be.
Yeah, and that's a big chunk on $1 million house. That's $200,000, right?
Yeah, it can make a very big difference.
So that's why I keep saying every time I do these videos, I say, hey, talk to a local agent, talk to a local lender. I'm in Anaheim Hills, but if you're in Texas or Montana or whatever, we'll refer you to agents or lenders that know that area more than we do. I may talk about Atlanta with Mathew, and I may talk about Southern California, but market is hyper local. So know your market, whether you're buying or selling, especially now with so much information, so much garbage out there. My opinion is most buyers and sellers are more confused, but they want to make the decision. I'm sure it's happening to you. When you have a buyer, when we send them a list of homes, they don't respond. Guess what they'll do? I want to see these 5 homes. Mm-hmm. Have you seen that? I've seen that with other agents. Oh no, I want to see, I have this buyer right now and I want to see these. What about the ones I sent you? No, I want to see these.
Yeah. Well, I mean, when it's a new client, that happens more. I think as I get to know them, I learn even, every time my philosophy is every time I go out and show a house to somebody, one of two things better happen. If I'm going to keep working with that buyer, okay? Either they're going to buy that house and like it, or I'm going to learn something about what they like and don't like, so I can better target the listings. If I'm learning and gathering data from it, then it's not a wasted time. It's not wasting time to show it.
Right, because once they go in the house, they may say, "Oh, I like this open floor plan, or I like a bigger kitchen, or I like this." So we learn as agents, we want to know, but it's minor, but it does help us in finding them a home or selling their home. It does make a difference. Yeah.
And limited inventory, sometimes I got to go out and find stuff that's not even on the market. Networking with other agents that I know that have upcoming product and stuff, and if the better I know what my clients are looking for, the better I can help them.
Right. Okay. The other one I'll talk about, and this is a wrench also that we don't know what's going to happen. As you know, in March or August 2024, we had the DOJ and the NAR come up with the new regulations where sellers can still pay the buyer's agent commission, but before you go out and show, you have to have a buyer's signature and you have to agree with them to pay the commission. Has that impacted? I'm not saying to you, but in general, what have you seen the impact of that? Are buyers paying commissions, or are the sellers still paying the commissions in general?
In general, the sellers are still paying the commissions. I haven't seen any major change. The only thing that's changed really, and I've always gotten a written buyer agency agreement even before that settlement. It's the professional way to do business.
Right.
So the main thing that's changed is I don't like the fact that when I'm working with a buyer, I can't tell them in advance before showing them the house whether they're going to have to pay my compensation or the seller will pay it. Now, I haven't had one yet since that went into effect where the seller didn't agree to pay.
Right.
Okay. So
they are paying, right? Yeah.
In practice, they're still paying and everything is the same. It's just that it was nice to know in advance before and not have this big question mark over, having my buyer fall in love with a house and start to attach themselves to it.
Right.
Because I do have a lot of buyers that can't pay my compensation.
Yeah, they don't.
So if the
FHA
seller
buyers, right?
refuses,
Yeah.
If we make an offer and it says the seller to pay the commission and they won't do it, I have
Right.
buyers that, as much as they like that house, they're going to have to find another house, not because
Right.
I'm steering them or telling them not to buy it,
Right.
but because they will lack the cash to close, and
Right.
they cannot commence that transaction.
Right. Yeah. Yeah.
Yeah.
It hasn't really made that much of an impact. Sellers are still paying. But what has happened is, if I'm a listing agent, I have to explain to the seller that, hey, I'm writing a 3% or 2% listing commission, but that's only paid to me. But be prepared when Matthew brings an offer, and if the buyers like the offer, most buyers in general, I would say 80%, don't have the extra money to pay 3%. I'll give you, like, I'm in Anaheim Hills, the medium home price is about 1.2, right? If I ask for 2.5% commission, that's almost what, $30,000 or whatever. So the buyer not only has to come up with, let's say, putting 10 or 20% down, which is almost $200,000 plus the closing cost. Now he has to come up with 25, 30,000 to pay me, and they're not going to do that. So we explain to the listing agent or the seller that, hey, be prepared to pay. And most sellers that I've talked to and have written offers, they pay that and they understand. As long as the listing agent, the seller's agent, is strong enough to explain to the seller, be prepared to pay the buyers.
And that's just it.
That's the key.
We'll have some bad
apples out there
that don't have that conversation.
Right.
And the other thing is, in those bidding war situations, those homes that have 10 or 20 offers on them in the first weekend,
right?
On those, there very well could be someone in that set that is a cash buyer or whatever that doesn't have an agent and whatever. And that can, I think, if the market were that strong where I am, I would see more instances where the buyer's got to pay.
Right. Okay. So. Yep. Okay. And the last few things I want to touch on is general home buying and selling, not advice, but things to remember. So if you're a seller, for example, or if you're a buyer, and we won't discuss much on it, but I'll kind of read what this report says, is that if you're a seller, then in today's market, decluttering and stagings are essential for sellers. Very important than 5 years ago. People want your house to be decluttered, and staging is very important because it helps you sell tremendously. So we won't discuss too much on it, but that's something to keep in mind. If you are a buyer, buyers are encouraged to inspect homes thoroughly and consider market-specific trends. A lot of the homes we sell is as is, right? But that does not mean that buyers cannot inspect it. I recommend to all my buyers, bring a professional inspector, which I recommend them 2 or 3 companies, and then they have one. And then after the inspection, we can ask the seller to fix it or explain it. If you feel like you want to back out, then you can back out. But you have to do inspection, no matter how many upgrades they have or whatever. That's one thing that I highly recommend.
Yeah, of course.
Right. And then as far as the buyer goes, refinancing strategies should be approached with caution due to rate volatility. What you were saying earlier, you don't like adjustable rates, because what if they keep going up? You take a 7% adjustable, and what if it's 8% next year? Then what?
Yeah, I'm not a fan, and I'm not a fan of even doing. Some people like to get the lower rate by doing a 15-year loan, and there's nothing wrong with that. It's actually, you save some money doing it. But my philosophy personally is take the 30-year loan. You can always make extra principal payments on it,
right?
And you can pay it off in 15. But the amount that you have to pay each month, lower. Which means 2 things. It means if you fall on hard times, which can happen to anyone, medical bills, whatever. It's, even wealthy people can have some hard times. The amount you have to pay to not lose your house is less. And the other thing is, if you are wealthy and you want to get into investing or something like that, and you want to leverage the bank's money to buy more properties and have rentals and things like that, the amount that affects your debt to income ratio is the lower payment.
Right. So not to put you on a spot, but if you have a small calculator, just guesstimate it. Let's say an average medium home price today in USA is, let's say, 400,000 or 420, right?
Okay.
Let's say 400,000. Somebody comes in with a 10% down. So let's say, for the calculation's sake, the loan amount is 350.
Mm-hmm.
If I was to buy that at 30% or 30-year loan, and let's say 6 or 7%, what would be my payment be versus a 15-year? How much payment jumps? I mean, ballpark doesn't have to be accurate, but
I would say the 15-year, it's not double, it's the 15-year, you're going to get a lower rate. It's probably about 60% higher payment.
So if I had a 2,000 payment on a 30-year loan, I'm going to pay what, 3,000 on a 15 or even more?
Yeah, 3,100, 3,200.
So it's a big chunk. Like I mean, you have to qualify.
It is. You're paying it off faster, but
right.
If you take the 30-year loan and you pay the same $3,000 a month, you're going to pay it off in 15 years anyway, or less.
Right. But a few months ago, and I go back to saying videos because we have this on my channel. If you want to see a video, I did a video a couple of months ago, talks about how to pay off your mortgage faster. And you'd right, but I think I talk about 7 or 8 things you can do to pay off your mortgage faster. So what you were saying, hey, why you want to buy a house at 400,000 with a 3,000 a month payment where you have fixed for 15 years? Once you take a loan of 2,000 and then every month pay 1,000 a month if you can afford it, or 500 a month.
Yeah, it takes
the things you can do. There's so many. I have 7 things you can do. So check that video out. It talks about pay off your house faster. So
right. The other thing people need to realize when they refinance, when you refinance, it resets your loans are always front loaded where the first few years your entire monthly payment is almost all interest. And then you start chipping away at the principal.
Mm-hmm.
A lot of people they refinance and they're all excited because their payment's going down, and they're and they even get a month without a payment, where they get to skip a payment and stuff.
Right.
But what they don't realize is maybe they had a 30-year loan, they paid on it for 10 years. So now they're 10 years into it. They're at a point where a decent percentage of their monthly payments going towards paying down principal. Then they refinance to a new 30-year loan, and they reset the amortization schedule.
In other words, you got a 40-year loan now, totally, right? 40-year loan.
Essentially, you did, yeah. And people don't realize, and lenders are not upfront about that. I am, but a lot of lenders aren't. Now there are reasons to do that. Like I did that on one of my rental properties, but that was because I was looking for cash flow above and beyond the rent roll, and it was a very calculated decision. I didn't do it without knowing what I was doing. I made the decision that it made business sense to do it.
Yeah. So just to put in perspective, I know, and I'm not a lender. I'm not I know that if I buy a $500,000 house, and let's say I pay 6% and keep it for 30 years, that house is going to cost me $1 million because my interest is going to be about $500,000 ballpark. So I'm paying $1 million for the house. But here's the catch. If I went in there 10 years and refinance again, now that house is going to cost me 1.2 because I added 30 more years of interest.
Right.
So yes, you will reduce your payment by 300, 400, whatever. But at the end of that 30 year, you paid 1.2 for the house instead of $1 million with the house. So the math, you got to do it, and don't refi just because it's half a point. I know lenders tell you to do it. Hey, drop it, no appraisal fees, no, but they don't tell you that you're going to pay $200,000 over the life of that house.
Right.
So talk to a skilled realtor, talk to a skilled lender, talk to us, direct messages. We'll refer you to these guys. Talk to them. You have no obligation to buy or sell or refinance. At least you know what you're getting. So that's my call to action.
Great advice.
We're here to help you. You're here to quote, I won't say advise, to guide you, because there's so many people. I have a friend of mine, a very good friend of mine. When the rates were down, in the last 10 years, do you know how many times he has refinanced? 8 times.
8 times.
8 times. Because guess what? His buddy is a lender. He's refinanced 8 times in the last 10 years. And I told him, you're not doing the right thing, because now what happened was your 10-year loan in 10 years, you've added 4 years to the loan. He bought that house for like almost $800,000. So 800 plus 800, it was going to cost him a 1.6 million with the interest rate
Right.
on average. Now it's going to cost him 1.9 because refinanced
And
so many times.
it also comes down to a person's financial discipline as well. Like
Mhm.
you can do that if your friend who's doing that, if he's saving $300 a month by doing that, maybe he's not paying off the principal as fast, but he's got an extra $300 a month. Now, if he takes that $300 a month that he would have had to pay on the mortgage and puts it towards principal every month, he can get caught up on that pretty quickly. Likewise, if he invests it wisely, it can grow and make it so that he'll have the cash that he would have, paid to pay the principal down at the end with. So if you use it smartly, it's almost 6 of one, half a dozen of the other. It doesn't matter as long as if you know what you're doing and you're smart about what you do with that extra money. But most people do it and then they take the extra money, buy a fancy car, go on vacation, buy whatever, clothing, fancy shoes. That is that's gonna put you in the poorhouse really fast.
Right. And I would say most do that. I mean,
Yeah.
What does stats say? That 39% of the people don't have a stock account or never bought stock.
Right.
More than 50% of the population, working population, are living paycheck to paycheck. So what percentage is going to actually save the money and actually you think will put it and invest it? They're not going to do it.
Yeah.
In general, I would say my experience, an average consumer is not going to save. They're not going to save, period. Something's going to come up. Medical bills, kids' bills, car. Yeah, you're the exception. But,
when I make decisions like that, it's very calculated. And I'll say, okay, I'm going to do this.
Yep.
I'm going to take this $300 a month. I'm going to put it in the S&P 500 index fund. It's going to grow at this rate, and it's very calculated. And I'll run the numbers and say it makes business sense to do this. I'm going to end up financially better off in the long run by doing this.
And there's a lot of people who do that. Kudos to them. But I'm talking an average guy is not going to do it.
Right.
Hopefully you're not average. Guys listening to us are not average. So you're going to do good things. So good luck to you. So on that note, I think we'll call it a day. Unless you have any last thoughts, we'll call it a day. And thank you for coming. And we'll do this every week, Mondays at 4:30 Pacific Standard Time. Join us. The channel is Home Service Central. And we're glad to give you guidance and information that we have. Hopefully you can use it. And like I said before, direct message Matthew or myself, and we'll refer you to a lender or a financial planner or a realtor. Talk to them. There's no obligation. Get ahead. Know more so you can be better, so.
Yeah. And thank you for having me on again. I really enjoyed it. And I will, I don't have in case you need my phone number.
I have it in the description. It's in my description as well.
Okay, good. Because I
have your website, but you can say it out. I'm say it out. That's fine.
And and I actually have a YouTube channel of my own, but I haven't been. I'll be honest with you, I haven't been producing content on it. It's been kind of stagnant. I will be getting back into it, and one of these days I'll have my own live stream, and I'll have you on as a guest on mine.
I'll be glad to show up. Yeah, I'll be glad to do that.
But
anyway, thanks a lot. We'll catch up with you, and I'll call you again also, Matthew. Thanks again.
All right, sounds good. Thank you.
Thank you.
Take care.